If I have 5,000 ounces of gold in my warehouse, I will sell 5,000 ounces on COMEX. I'll sell it short. Now it's a covered short because I have the metal behind it. I sell 5,000 ounces on paper. If the price goes down by $100 an ounce, and when you look at the amount of central bank buying that we've seen this year, which is exceeding just about any time in history, you look at the central banks, they bought more gold over the last 2 years than any time in history, and that is continuing. Same thing with silver. We just got numbers that, as an example, that India bought 60 million ounces of silver in October and another 20 million ounces in November on top of 304 million ounces in 2022. And these stars are all lining up perfectly. You see massive central bank buying at the same time that they're selling and not rolling over their treasuries. There is a shift being made by the most powerful people in the world.
According to Andy Schectman, coinciding with these events, he has felt for a long time that the suppression of the Western market has enabled large central banks to reposition using the suppressed leverage of the West against us. In other words, he suggests that they are using the manipulated price to accumulate massive amounts of gold and silver. Schectman explains that the COMEX exchange was originally designed to offset risk. For instance, a farmer who plants a field of wheat in the spring wants to harvest in the fall. However, there are various risks in between: a bumper crop, a rough year, pests, too much rain, or not enough. The futures market pairs up the farmer and the baker. The baker needs wheat to make bread, and the farmer needs to sell his wheat to cover his costs. The farmer plants the crop and sells his production forward into the marketplace, where the baker agrees to buy the wheat in 6 months at a set price. This arrangement helps both parties manage their risks. In a similar manner, if Schectman had 5,000 ounces of gold in his warehouse, he would sell 5,000 ounces on COMEX. He would sell it short, but it's a covered short because he has the metal behind it. It's not a naked short where a commercial bank with vast amounts of money might sell to create a perception of reality.
What it basically is this. So I have 5,000 ounces in my warehouse. I sell 5,000 ounces on paper. If the price goes down by $100 an ounce, I'm down $500,000 in my inventory. 5,000 ounces at $100 a piece. That's $500,000 I'm out in my physical holdings. But what I sold short on COMEX goes up commensurately. I'm market neutral. They offset one another. It is a way for me to offset my risk and not to speculate. Now, I asked my head trader, I don't know, might have been 6 weeks ago now already, but you'll get the point. I said to him, Ryan, what does it cost for us to control one COMEX gold contract? One COMEX gold contract is 100 ounces of gold, paper form of gold. So you're talking $200,000 plus. And he said, well, the trade costs us just a few bucks, but we have to have roughly $7,000 in our margin account. That's it. So if the price never goes against you, you don't get a margin call. So I have $7,000 in my margin account. I can control $200,000 worth of gold. Well, what if I'm a commercial bank or a central bank with 500 million in my margin account? I have $500 million in my margin account. I now control $15 billion worth of notional gold and silver contracts. And they don't need to have the gold backing it because they have the deepest pockets. And they also know where all the pain points are. They're the ones that sell the options largely. So they know where everyone is positioned. They know where they're going to get people to capitulate. So what they can do is they can paint the tape, as it's called. They can control the narrative by buying up through resistance levels, triggering buy orders, or selling down through resistance levels, triggering sell orders, which begets more selling or begets more buying. And so it's a corrupt system. It is one that is over leveraged in this case by about 35 times and rehypothecated, which means everyone who has a contract, it represents 100 ounces of gold, or in silver, 5,000 ounces of silver. Now, I haven't looked at the gold lately, but just the other day I was looking at the silver positioning. And in the registered category on COMEX, that's the category where the bars that are supposedly backing the contracts are available for delivery. It was rehypothecated 1,490%. In other words, 1,500%. In other words, there's 15 times more contracts than there are bars backing them. Yeah, so you have these commercial banks with literally millions and millions and millions of dollars worth of short positions in gold and silver, meaning they're selling, driving the price down. When you short something, you do it with the anticipation and the duty to pay it back, but you are anticipating paying it back at a lower price.
According to Andy Schectman, big banks can short the price, drive it down, and then cover those shorts at a later date at a lower price. When you sell short, you expect the price to go down. When you go long, you expect the price to go up. Schectman asserts that many banks are naked shorting, meaning they are selling metal they do not have and anticipate never having to deliver, opting instead for a cash settlement. However, if the price suddenly rises significantly, you must obtain the metal to put it back into the system or cash settle. Schectman notes that as the price rises, it forces people into the market. If you want to stand for delivery, but no one wants to sell as the price spikes, you have to go outside the system to find it, which can be very costly. This can bankrupt you quickly. Schectman points out that this is what happened to Bear Stearns in 2008. Former CFTC Commissioner Bart Chilton admitted on a podcast with Chris Marcus that Bear Stearns was massively short on silver. When the price went from $12 to $21, they couldn't cover their position and went out of business due to that leverage. As the price moves rapidly against you, you must either acquire the metal or cover it with cash. If the price rises quickly, it can force everyone to cover their positions, which means buying back the metal. This buying, combined with others buying, can drive the price up so fast that short positions get squeezed, potentially leading to a collapse in short positions and business failures.